Hi, this is Ian from Global Market Edge. When people talk about crypto, they often put Bitcoin and Ethereum in the same bucket, but I think this is a mistake. Bitcoin and Ethereum are both major digital assets, but they are not really trying to do the same thing. Bitcoin is mainly a digital scarcity asset. Ethereum is mostly programmable financial infrastructure. One is closer to a digital store of value. The other is closer to settlement rails for applications, tokens, smart contracts, and future financial products. And if you're going to trade or invest in either of them, I think it's important to understand the difference. Let's start with Bitcoin. Bitcoin's core idea is very simple. There will only ever be 21 million Bitcoin. That fixed supply is what gives Bitcoin its main investment narrative. It is not controlled by a central bank. It is not issued by a government. It is not something that can be printed because a currency has too much debt or because politicians want to spend more money. That is why many people describe Bitcoin as digital gold. Now, whether you agree with that description or not, the point is that Bitcoin's main value proposition is scarcity. It is designed to be hard money in a digital form. In a world where governments keep running deficit, debt levels keep rising, and paper currencies keep losing purchasing power over time, Bitcoin appeals to people who want an asset outside that system. That does not mean Bitcoin is safe. It does not mean Bitcoin is cheap at any price. And it definitely does not mean Bitcoin cannot fall sharply. Bitcoin is volatile. It still trades off liquidity, leverage, sentiment, interest rates, and risk appetite. But structurally, the Bitcoin thesis is simple. Limited supply, no central issuer, global transferability, and a growing role as digital collateral and long-term store of value asset. That is Bitcoin. Ethereum is different. Ethereum is not just trying to be digital gold. Ethereum is a programmable blockchain network. It allows developers to build applications, smart contract, tokens, decentralized financial products, stablecoin infrastructure, and settlement systems on top of it all. So, when people talk about Ethereum, they are not only talking about ETH token, they are also talking about the network, the ecosystem, the applications, the developers, the smart contract, and the settlement activity, and the potential for real-world assets to move onto blockchain rails over time. That is the big difference. Bitcoin is primarily about scarcity. Ethereum is primarily about programmability. And this is where tokenization comes in. Over time, more financial assets will become tokenized. That will include stocks, bonds, private credit, insurance contracts, real estate, commodities, invoices, royalties, carbon credits, and other assets that may not even exist yet in their current form. The reason this matters is because tokenization can make assets easier to transfer, easier to fractionalize, easier to settle, and easier to use as collateral. Instead of relying on a slow back-office system, some assets may eventually settle on blockchain-based infrastructure. Now, an important point. Not all tokenization will happen on Ethereum. That will be too simplistic. Some of it will happen on private blockchains, some of it will happen on other public blockchains, and some may happen through systems built by banks, asset managers, exchanges, or governments. So I would not say Ethereum is the only rails, but Ethereum is one of the main public blockchain ecosystems for tokenization, smart contract, decentralized application, and settlement. That is why Ethereum matters. It is not just a coin that goes up and down. It is part of a broader infrastructure thesis. Bitcoin is digital scarcity. Ethereum is one of the main programmable settlement ecosystems. And that difference affects how you think about both assets. With Bitcoin, the question is usually, do people want a scarce, non-sovereign, digital asset in a world of currency debasement? With Ethereum, the question is more, will more financial activity, tokenized assets, stablecoins, smart contracts, and settlement systems continue to move onto public blockchain infrastructure? Those are two different questions, and that is why Bitcoin and Ethereum often behave differently. There are times they both move together because the whole crypto market is being bought or sold, but the underlying thesis is not the same. Bitcoin is more macro scarcity, collateral, and store value. Ethereum is more infrastructure, usage, applications, and network activity. That distinction matters for traders too. If Bitcoin is moving because of macro liquidity, ETF flows, dollar weakness, or demand for hard assets, that is a very different driver from Ethereum moving because of network activity, tokenization headlines, staking, stablecoin growth, or demand for decentralized finance. The mistake many traders make is treating every crypto asset as if it has the same reason for existing. They do not. Bitcoin and Ethereum have different roles. They have different narratives. They have different risk, and they attract very different types of capital. Bitcoin may appeal more to people looking for digital scarcity and a hedge against currency debasement. Ethereum may appeal more to people who believe future financial markets will increasingly use blockchain-based settlement and programmable infrastructure. But there is one thing both assets have in common. They are volatile. A good long-term thesis does not protect you from bad risk management. You can be right about Bitcoin long-term and still lose money using too much leverage. You can be right about Ethereum's infrastructure role and still buy in at the wrong price. You can believe in tokenization and still get liquidated on short-term moves. That is why price, position size, leverage, and risk control still matter. No asset is automatically cheap, and no thesis removes the need for discipline. So the simple takeaway is this: Bitcoin is best understood as digital scarcity. Ethereum is best understood as programmable settlement infrastructure. Bitcoin is a store of value thesis. Ethereum is the rails and application thesis. They are both important, but they are not the same trade. And if you understand that distinction, you can think more clearly about what you are buying, why it is moving, and what risk you are actually taking. This is Ian from Global Market Edge. This content is for general education only and is not financial advice.